Well, hello, welcome to the special edition of the Global View with me, Tanvir Gill. In the current global market turmoil, everybody is looking for answers. There is extreme gloom in the market, so I thought, why not invite one of the most influential global market investors to throw more light on what's happening. My guest today on the show needs no introduction. He's none other than Mohamed El-Erian, Chief Economic Advisor at ALLIANZ and Chairperson of President Obama's Global Development Council. Mohamed, in fact, is coming out with a book that could hold some answers to rebuilding efficiency in financial markets. Let's hear it out from Mohamed on what he sees as the only game in town. Mohamed, it's great to have you on the show. Thanks very much for taking out the time to speak with us. Let's start off with the title of the book, which is intriguing. But what got my attention was, of course, a subheader that talks about central banks, instability, and the next collapse. Now, is that the chronology that we are staring at right now? And if so, where are you seeing the likelihood of the next collapse over the near or medium term?
A collapse is a possibility, but it's not the dominant possibility. The ordering that you cited, central banks, instability, and collapse, speaks to a world that has been artificially boosted by central banks. Not because this is what they wanted to do, but this is what they felt obliged to do. In particular, the Federal Reserve and the European Central Bank have been waiting for other policymakers on both sides of the Atlantic to step up to the plate and deliver a comprehensive policy response. In the absence of doing so, they have had no choice but to be the only game in town. The result has been to decouple financial asset prices from fundamentals. And that is the source of instability, the second element. The longer this instability continues, the more the current path we're on will end, and then it can tip either to another crisis, meaning recession, meaning financial chaos, or alternatively, it could force the hand of policymakers to finally do the right thing.
Right, Mohamed. Is the clock ticking then, on a timeline?
So the clock is definitely ticking. How close we are to this T-junction where the current road that the global economy is on ends, and then we tip one way or the other, it's hard to tell. A lot will depend on emotions, believe it or not, and a lot will depend on non-economic issues. But I think the important thing and the message of the book is understand that we are on this T-junction, understand that the current road we're on is likely to end, and ask yourself, how will we behave as we get closer to this T-junction, and what can we do today to increase the risk of navigating it well?
Right, then how do you study the scenario right now? Do you think a large part of the turmoil that we are seeing is the markets in a way giving up on monetary policy support after 8 years as being ineffective and perhaps staring at a prolonged period of low growth, low inflation?
I think you're absolutely right. I think the markets are finally understanding that the reason why asset prices were supported by central banks is not to make the markets feel better. It is not that central banks are what my daughter would say, BFFs for the markets, i.e. the best friends forever. Rather, central banks were using the markets as a conduit to economic objectives. And now they are either unwilling, in the case of the Federal Reserve, or increasingly unable, in the case of China, Japan, and soon Europe. They're unable to do that. So the markets have finally understood. And the result of that, in technical terms, is a change in the volatility paradigm. In the old days, you could trust the central banks to repress volatility. And the more volatility is repressed, the more comfortable people feel about risk-taking. Nowadays, with the central banks no longer as effective in repressing volatility, markets are pricing in a new volatility regime, which means less risk-taking, which means a sell-off in risk assets, particularly equities.
So let's bring in the sum and summary of the book. What specific solutions are you proposing for central banks to change their approach?
So basically, I'm suggesting that central banks have to be much more insistent on the political system to explain that they cannot continue to be the only game in town. And if they do, they will go from being part of the solution to part of the problem. And that the responsibility has to be shifted to the political system. and that central banks have to be much more open and frank about the situation and the bimodal distribution that we're facing. Otherwise, it will be what economists call moral hazard. Politicians will continue to depend on central banks, and they will shift way too much of the burden on central banks, and central banks simply do not have the tools that are required for the tasks at hand. They've bought the system a lot of time, they've borrowed a lot of growth and a lot of financial returns from the future. Now it's time for other policymakers to react in order for fundamentals to validate asset prices.
Interesting thoughts there, Mohamed. All the best with the book. Let's talk about the markets as they are currently. It's been a tough start to 2016, and the key concern has been crude. Now 30, 20, 10, the estimates are getting revised lower, and the oversupply route seems to be only getting worse. The IEA have also acknowledged that, with Iran adding to the supplies, things may just go southwards from here. But you've advocated that the oil market could see a massive supply destruction. Right now, what we're seeing is a demand destruction, but we perhaps could be moving towards a supply side destruction as well, which could lead to reversal in prices. What could lead to that happening? I mean, do you expect that there could be some big oil companies that could go belly up? Would that mean that 2-3 years down the line, oil could be back between $75 to $100 a barrel? Also, where will the relief on the demand side come from?
So it's important, I think, to identify the three factors that have led to this disorderly oil market. The first one is, of course, more supply, in particular from fracking, from shale energy. The second is lower demand, especially as China slows. But these two things do not explain where oil prices are today. What explains where oil prices are today is the third factor that completely unhinged the market. And that is the change in the swing producer role. Up until November of 2014, Saudi Arabia, and therefore OPEC, was willing to speak to the possibility of being the swing producer. That is, reducing production as prices come down in order to support prices. But they rightly figured out that this was a lose-lose game, because the more they reduced production, the more other people would increase production. And once they lost their market share, it was very difficult to regain. So Saudi Arabia, and therefore OPEC, exited that role. And you took away the stabilizer in the market. And therefore, you got this very disorderly adjustment. In terms of where we go from here, prices today are too low given fundamentals. Demand hasn't fallen to the extent that would be warranted by where prices are. And we're about to see massive supply destruction. A lot of the supply today has become uneconomical. We are seeing a significant curtailment of investment in new productive activity, particularly in shale. We are seeing rigs being shut down, particularly in the United States. So there will be a massive destruction of supply. So if you look over the long term, 2 to 3 years, these oil prices will look low relative to where we're going in 2 to 3 years. But how we get there is going to be incredibly volatile because we have changed operating paradigms.
Fair enough, Mohamed. Let's move to the second key concern, which is currency. So we've discussed crude. Now the second key risk is currencies. The only trade that worked in 2015 is the dollar. With currencies, the mindset is largely that a weaker currency would help export competitiveness. But here's my point. In a scenario where global growth is slowing, how much of that approach really works? How much can countries compete for the export markets in a shrinking demand cycle?
You're absolutely right. I mean, one of the tragedies is that the lack of global economic cooperation has meant that country after country has looked to the exchange rate as a way to boost their well-being. The US did it from 2010 up to 2012. Europe has done it. China and the emerging world is doing it. And we inadvertently could stumble into a stealth currency war. Now, the problem is that policymakers view the exchange rate as an instrument because they're not willing or able to move on other policy measures that are required. But as you point out, there's a couple of problems with that. First, it's beggar thy neighbor. So my gains come at your cost. And therefore, There's a question of how the whole system solves. The second element is simply less effective today. Devaluations have a lower impact because production chains have become much more diversified, and therefore you don't get the same benefit as you once did. So it's a sad reflection of global economic cooperation that we have now stumbled into country after country thinking of the exchange rate as being the solution when it's not a very good solution. In fact, if anything, it could add to the problem.
Right, but that brings me to my next question, Mohamed. Is the call really then about whether to have a strong currency or a weaker one in this environment? You know, for example, in India, that's a key debate. The rupee has been far more resilient than other emerging market currencies. Now, is that a good thing or not quite, as India loses out on its export potential?
Yeah, you know, it's a hard choice. Remember, and this is really, really important, remember how the global system is built. It's built on the assumption that the core of the global system, which is made up of the countries that deliver the global public goods, they deliver the reserve currencies, they deliver the securities in which you and I are willing to save for our kids. The global system is built on the assumption that the core is responsible, and that to the extent that you have volatility and irresponsibility is in the periphery. But over the last few years, we have seen a new mantra develop in the core. This notion that acting irresponsibly is now responsible. This notion that taking interest rates to zero, driving down your currency, buying securities on the market by central banks, that this, which was once viewed as irresponsible behavior, is now responsible. When the core acts irresponsibly, quote unquote, it becomes very difficult for the periphery. So in the case of India, people are right. It's very confusing today as to how do you operate in such an unusual neighborhood. Do you let your currency go and follow other countries? Or do you maintain stability in your currency and adjust some other place? I think the answer for India is a bit of both. You certainly don't want to appreciate too much, but you certainly don't want to rely on your currency. And I think what's encouraging about India is you're seeing first a very responsible policy by the central bank under Governor Raghu Rajan. Secondly, you're seeing an understanding in the political system as to the need to move forward on structural reforms that have held back India's growth rate. And thirdly, you're seeing foreign investors very interested and looking as to what are the domestic investors doing, because the domestic investors ultimately have the best information. So India could come out of this in actually a well-placed situation, particularly since they're also going to benefit enormously from the lower oil prices.
Right. The other key currency which is giving everybody sleepless nights is the yuan. It was well known that China would internationalize the currency in its course of joining the SDR basket officially by September 2016. The peg against the dollar will be broken slowly. Post this phase of adjustment, where do you see the yuan? Yes, it's getting weaker right now, but over the long term, do you see the yuan breaking the dollar's dominance as a reserve currency? How do you see the yuan 3 years hence, 5 years hence?
Yeah, so China is trying to deal with two issues. One is matching its domestic responsibilities with its international responsibilities. So domestically, the requirement is for a weaker currency. But now that they are globalizing that currency, now that the yuan, as you said, has joined the elite basket of currencies that constitutes the SDR basket, they also have global responsibility. And matching these two things is hard. But there's a second element, and I think this is the one that has concerned the markets the most. The markets have traditionally characterized Chinese policymakers as very effective. And a few things have happened on the stock market and on the currency market that has shaken investor confidence in the policy-making savvy of the Chinese government. First, the notion of the surprise devaluation in August. It came out of the blue, it wasn't well explained, it wasn't well communicated, and that questioned whether the Chinese were losing their effective policy making. And then most recently, what you've seen is flip-flops, including, interestingly, the Chinese government losing some of its influence on the offshore trading of its currency. These two things have shaken investor confidence in Chinese policymakers, and therefore they have now priced in a much higher uncertainty premium. I believe, having observed the Chinese policymakers for decades, that they learn very quickly. Yes, it's more complex to manage the economy now that it's bigger, now that they're liberalizing, now that they're globalizing. But if you look at how they operate, they tend to learn very quickly. So a policy mistake in China tends to be followed by policy improvements. And my expectation is that this will happen, and I think that markets will finally get it, that this was a slip as opposed to a major fall on the part of the Chinese policymakers.
Since we touched upon India, I want to get in a couple of questions on the Indian economy too. On a relative basis, the World Bank and IMF expect India to grow more than 7%, to outperform other emerging markets, to outperform China, being one of the fastest growing economies in the world. How do you see the India growth story? Should the RBI cut rates further, or do you think that the 125 basis points cut that's come so far are sufficient?
So as I noted earlier, I see the India growth story as a very promising one. First, major terms of trade benefits. Lower oil prices are a major plus for the Indian economy. They're going to lower the production cost across many, many different sectors at a time when India needs that extra tailwind. Secondly, I think that the Reserve Bank has behaved very responsibly. I would not encourage them to cut interest rates a lot more. I think there's a danger that they fall into the same trap as others has fallen into, which is that the central banks takes on too much of the burden of policy making. And I would support and urge the government to move faster on the structural reforms. India is an economy that has tremendous potential that can be unleashed through good policy making and a lot more private investment. And it's encouraging to see that finally the growth rates are at a level that's commensurate with the country's potential. And it's really important to build on this momentum. Otherwise, India will become vulnerable to what is becoming a very uncertain neighborhood. I tell people, be careful. In order to become a good house in a challenged neighborhood, you've got to be a really good house. And that's important. And India has the ability to be a really good house in a challenged regional and global neighborhood.
Right. Mohamed, how do you contrast the India story with that of China? Now, opinion on China is as diverse as it gets. You have the believers and the non-believers. Which camp are you in, and what's your own growth outlook for China?
So there's two issues. If you ask me about the economy, I'm a believer in the sense that I believe that China will soft land its growth rate in the 5 to 6.5% range, that will be able to stabilize its economy, and that it will not have a hard landing. I'm not a buyer of the hard landing scenario for China. It's a possibility, but it's not the baseline, in my opinion. But there's another element, which is China also has financial excesses. There's been too much risk-taking. In fact, China has fallen into a trap that the United States has fallen into. If you recall, 10, 15 years ago, the United States decided to pursue a social objective, home ownership. It was decided that for social reason, spreading home ownership was a good thing. And guess what? It went too far and created a housing crisis. China made the same mistake. China believed that spreading ownership of the stock market was a social good. Why? Because it would give its people a stake in pro-market reforms. And just like the United States went too far, China has gone too far. So there's going to be a financial adjustment in China. And I would be careful when it comes to that. I think that is going to go on for a while. But I'm a believer that from the economic perspective, they will be able to soft land their economy in a 5 to 6.5% range, and they will not hard land into a recession.
First it was about the crude market, then currencies, then China, and now investors have started getting worried about what happens next in the US. You have said that the US recovery seems fragile at 2.5%. What's the path ahead then for the Fed in terms of rate hikes? Do you think that their case becomes weaker to go ahead and execute the following rate hike that they had planned?
So they go slower. I do not think you get their stated expectation of 4 hikes or 100 basis points. I think at most you'll get 2 hikes or 50 basis points. I think critically the Fed has an important to-do list. First and foremost in this to-do list is to remind markets over and over again that this is not your traditional cycle. This is a very different interest rate cycle. It's very shallow. It's going to be stop-go. They will stop. They may go back a little bit. Then they'll go forward. And when it ends, in a number of years, it will end well below the historical averages. And it's really important for the Fed to communicate this over and over and over again to the markets so that the market understand that this is not your traditional cycle. So in the short term, we will continue to obsess with when they're going to hike. So they will not hike in January. They may hike in March. At most, they'll hike twice this year, and they will not hike what they've stated, which is up to 4 times.
We've discussed all the risks that there are in the market right now. But what about the opportunities? Which are the 3 places Mohamed El-Erian would park his money across world assets in the current mayhem? In order of your preference, where is it that you see risk-adjusted value?
So given what I see, you would like to have a few things. First, you would like to have cash, quite a cash buffer. And hopefully your audience entered this period of instability with quite a bit of cash if they are investors. Why? Because cash buys you the 3 things that I identify in the book that are most important for bimodal distribution. Cash buys you resilience. Cash buys you optionality. You can change your mind. And cash buys you agility. You can pounce on opportunities. The second element that is clear today is that because of the nature of the sell-off, including what has happened in oil, you have good companies that have been hit very hard and well beyond what's justified. And that's understandable because when markets change volatility paradigm, you get contagion. So the second thing that you would like to see is the ability to pick up over time good companies at low prices and do it in a measured way over time, because it's very difficult to time it perfectly. Third, there are emerging economies that have been really badly hit, excessively badly hit in the latest downturn. Now, there's understandable reason why that has occurred. Remember, emerging markets are an asset class that either have too much capital coming in or too much capital going out. They never have the Goldilocks. They never have the just perfect flow of capital. It's either a feast or a famine. And a lot of them are facing famines right now. And I think that is also an interesting opportunity. So I would be also very selective in picking up some emerging market assets, but again, do it in a measured fashion.
Interesting views, Mohamed. Thanks very much for taking out the time to speak with us today and give us your perspective on the current global market turmoil. Really appreciate your views.
Thank you so much, and thank you for taking the time.
Well, that's time out then on this special edition of The Global View. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.